Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. And today we're diving into something that smells a bit like a desperate move for cash. But let's see what the numbers say. VSEE Health Incorporated is making some interesting financial maneuvers, and we're going to break down exactly what they mean for them and for investors. Plus, we'll give you our take on whether this is a smart play or a risky gamble. Before we dive in, if you like getting these kinds of unvarnished looks at company filings, make sure you hit that subscribe button and join our Discord community linked in the description below, where we discuss these things in real time. First off, let us tell you a bit about VSEE Health Incorporated. They are a publicly traded company, and filings like this one are crucial for understanding what is really going on behind the scenes. This report is essentially an update on significant recent events for the company. This specific document is a Form 8, which companies use to announce major events that shareholders should know about. Think of it as the official bulletin board for sudden corporate news. Their main product here seems to be common stock, which is what most people think of when they hear about buying a piece of a company. They also have warrants, which are like options that give someone the right to buy stock later at a set price. Now, the date that is really important here is the 13th of November, 2025. This is when the main events we're discussing today actually happen. The company entered into a couple of big agreements. First, they made a deal with an investor to exchange a promissory note. Think of a promissory note as an IOU, a promise to pay back a loan. This particular note had a face value, plus some extra costs, totaling over $500,000. So, they owed this investor over $611,000. What did they give in return? Well, they issued nearly 941,352 shares of their common stock. This is a way to settle a debt by giving away ownership instead of cash. This is often done when a company needs to conserve cash and believes its stock price will go up in the future, or simply cannot afford to pay the cash. This move itself is interesting because they are essentially giving up a piece of the company to pay off a debt. It signals they might be tight on cash or want to avoid further debt obligations. For investors, this means their ownership stake in the company has been diluted, meaning their share of the whole company is now a little bit smaller. But that is not all. They also set up a significant financial arrangement called an equity line of credit, or ELOC, with another investor. This ELOC is for a massive $25 million. This essentially means VSEE Health has the option, but not the obligation, to sell up to $25 million worth of its stock to this investor over a 36-month period. The company can decide when to tap into this line of credit, and the investor is obligated to buy the shares at a set price. The price they get for these shares can be a bit complex. It is generally set at 96% of the lowest trading price over a 10-day period before they decide to sell. But if the stock price gets too low, like below $1, that percentage can drop even further to 94%. This is a common feature in these types of agreements, designed to incentivize the investor while giving the company access to capital. There are also limits on how much they can sell at once, with specific dollar amount caps and percentages tied to how much is usually traded. This is to prevent them from flooding the market and crashing their own stock price. A very important restriction is that they can't sell more than 19.9% of their total outstanding shares at any given time. This is a regulatory safeguard. Both of these agreements, the exchange deal and the ELOC, come with standard legal protections for both VSEE Health and the investors. These are basically promises and assurances that everything is as it should be. This ELOC has a time limit. It will end either when the investor has bought the full $25 million worth of stock, or after 3 years, whichever comes first. Another key point for this ELOC is that the investor cannot own more than 9.99% of VSEE Health's total stock at any given moment. This is to maintain control within the existing shareholder base and to manage the implications for controlling interest. The money raised from selling stock under this ELOC will be used for general business needs, like paying bills and running the day-to-day operations. These agreements are detailed in separate documents called Exhibits 10.1 and 10.2, which are attached to this report. This section talks about selling stock that isn't registered with regulators, meaning they aren't going through the full, lengthy process of getting every single share approved for public sale beforehand. They are using exemptions like Section 309 for the stock swap and Section 4 at 2, or Regulation D for the ELOC. These exemptions are generally available for transactions with sophisticated investors. Both investors involved here are defined as accredited investors. This means they are considered financially sophisticated enough to understand and bear the risks of these types of investments without the same level of regulatory protection that applies to retail investors buying stock on an exchange. This is where they list all the supporting documents. Here we see the exchange agreement is listed as Exhibit 10.1, and the Directed Stock Purchase Agreement, which outlines the ELOC terms, is Exhibit 10.2. The report is signed on the 17th of November, 2025, a few days after the agreements were made, and it is signed by Imwijlai Iziku, who holds the title of Co-Chief Executive Officer. It is always good to see the top brass signing off on these important documents. Now, let's put on our Warren Buffett hat and look at the bigger picture here. VSEE Health is in a position where they've had to make these deals to get capital. The exchange of debt for stock suggests they might not have had immediate cash to pay off the promissory note, or they saw it as a more advantageous move. It dilutes existing shareholders, which is never ideal for them, but it does clear a debt. The $25 million ELOC is a significant tool in their belt, providing a lifeline for future funding. However, the terms are crucial. Selling stock at a discount to market price, especially when the price is volatile, can signal a company that is struggling to attract capital through traditional means. The fact that they can secure this line of credit and that the investors involved are accredited suggests there is still confidence in VSEE Health's long-term prospects, but the discounted pricing reflects the risk the investor is taking. The 19.9% and 9.99% limits on stock sales and ownership are standard provisions to ensure compliance with trading market rules and to prevent hostile takeovers or excessive control by a single entity. What this all means is VSEE Health is likely prioritizing access to cash to fund its operations and growth. It's a strategy often employed by companies that are in a growth phase or facing short-term cash flow challenges. The key question for investors will be how effectively they use this newly accessible capital. Are they investing in research and development, expanding their market reach, or shoring up their balance sheet without more context on their actual business performance? It is hard to say definitively, but these actions point towards a company actively managing its financial situation. In conclusion, VSEE Health has secured significant financial flexibility through these agreements, while diluting existing shareholders with the stock exchange is a concern. The ELOC provides substantial potential funding. The real test will be in their execution and how they deploy these resources. The company's direction seems to be focused on securing capital for operational needs and potential future growth, but the discounted nature of their stock sales suggests they may not be in a strong negotiating position at this moment. Alright, that is our breakdown of VSEE Health, Incorporated's latest filing. What is your take on these financial maneuvers? Do you think this is a smart move to secure capital or a sign of potential trouble? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord in the description for ongoing discussions. Thanks for watching, and we'll see you in the next one.